What's up, traders? I had to make a comment from the mobile command station, even though we are on vacation, so bear with the audio, but it's been a really intense 2 days worth of selling, a little bit more aggressive than I would have thought off of the resistance trendline based on the update video we put out on Tuesday after the close, but we also weren't looking for a big bullish breakout. Let me be very clear about that. There was nothing about that video that suggested we were loading the boat on the long side. We were watching for consolidation and to see if there were any possible buy setups down towards the lows, which as of right now does not look to be a likely case, which is the point of today's update video, just to make sure that no one's out there, trying to buy this pullback just yet. We're not seeing those confirmation signals. So this is the SPY weekly time frame chart. And all I would point out is that we're sitting right at the most important level of the second half of 2022, and as we're coming into 2023 here, it's going to prove to be quite pivotal once again. Now, we did reject off of the resistance trendline, and for those who are looking for the double top pattern, just keep in mind that it's not really going to get all that bearish until we actually take out the neckline of that pattern, which is the lows of the balance from early January when we were dealing with the light holiday trading volume. So sure, a new sell-off could develop. We could fall into that big recession everybody keeps talking about, but I wouldn't be overly concerned with it from a price action perspective until we actually take out the lows of late December, early January of this year. So let's continue on down to the daily time frame chart and see what's going on from this perspective. And might I also add, it's nice covering the market on the West Coast because it's only 2 in the afternoon as opposed to 6 at night back home on the East Coast. Regardless, S&P on the daily time frame chart, here's that big sell-off day as soon as the retail sales numbers came out on Wednesday morning, led to a nice rejection off of the trend line. We took out the low of Tuesday and continued to actually close underneath a really critical level at SPY 393.50, which is what we discussed for a ideal rainbows and butterflies type consolidation or pullback before possibly watching for some sort of break in the upward direction on a retest of the trend line. Now that we've violated that level, we should look to our next key component, which was the line in the sand level, the weekly level we just discussed, 389.50. With the daily close underneath, after repairing the overhead gap structure from here, I would actually read into this as really more of a bearish data point. It's definitely not as bearish as it could have been. It would have been more bearish to close like a solid red-bodied bar, or some sort of inverted hammer that just clearly rejected the gap with absolutely no lower wick on it. That would have been a little bit worse, but as of right now, it's definitely not looking great in terms of buying this pullback in the downward direction. We've also failed to hold on to the daily 50 SMA. So all things considered, we didn't print the ideal type candle that would have formed down here to signal a reversal. There is no hammer candle. We did not hold up at the rainbows and butterflies pullback area. So right now, I would actually advocate for being fairly neutral on the market as we try to resolve this area right here. Notice when I draw in a box like this, we clearly have overhead balance, overhead supply here, and we clearly have the demand zone, the balance from late December, early January this year underneath us. As we're chopping around in the midpoint, we don't really have all that much in terms of clear direction. Could we technically put in a higher low from here to here? It certainly is a possibility, but is this a lower high from here to here? It certainly is a possibility. And we know that the prevailing winds are, of course, down in the market right now. It doesn't take a rocket scientist to look at the weekly time frame chart and just make a general assessment that, yes, we are still technically in a weekly downtrend. So noting that, the structure underneath us has the opportunity to keep us fairly neutral in this box, I would say, but we're not as bullish as we could be. The close underneath that 389.50 is not bullish, but it's still, I don't want to discount the opportunity for maybe an oversold bounce here off the top of the prior range, especially considering that we're far extended outside of the weekly expected move. Now, the expected move did contract, and typically we look for the market to move from expansion to some sort of contraction, so it wasn't really an eye-opener there, but we're outside of that. So the market is not really comfortable from that perspective if we think about options hedging and where people are positioned. So just know it may not be wise to chase the downward move right now. It might not be wise to look for big new money shorts. How would I play this market going forward? Well, as we pointed out, this box will be fairly difficult to make a determination in. It will definitely be bullish once again if we can get over 393.50. And for bears, I would honestly look for consolidation here, build out a short-term bear flag, and a threatening of the breakdown level here, top of prior balance, at 385.50 would be your tradable move to the downside. You would look for the 100% retracement. The target, of course, would be 379.25. Dead cat bounce off of that, and then your weekly trend can resume in the downward direction. Scouting those equal lows on the weekly brings us to 355. Remember, that level is the lows of last year. So that's the bear scenario. And again, the bull scenario, which doesn't look to be in play right now because the structure just does not support it as of today's close, would be some sort of move higher, a higher low, and something that does this. this to get back to the trend line. I would probably be cautious of bullish trades here until we can either crack over this equal high or get over the resistance trend line in some fashion. And then the, of course, secondary metric would be some sort of higher low building out a daily uptrend, something that would look like this, of course. So moving down to an hourly time frame chart, purpose of this view is to really illustrate the gap close and the fact that the buyers did what they should have done, right? We gap down. Technically, the gap does close here, but we don't really go any further than that. So there's no aggressive buying action here on the tail of the gap down. The inventory just corrects, and then the natural sort of trend and the momentum, so to speak, of Wednesday picks back up, and we sell off into the close here. So I'm not seeing the aggression from the buyers in response to this pullback here. If it were going to be a healthier pullback, you should have seen buyers step up around this area. Just simply wasn't the case. There was the repair of structure, and that was about it from a buying perspective. Now, again, notice on the hourly time frame chart, you've got low, higher low. We're kind of putting in an equal low here, and I would say that the threat on this time frame is certainly the opportunity for more of a head and shoulders type look. So any lower highs, more time that's spent underneath 389.50, that opens up the door for this as an outcome, and a break of this trend line, as we know and as we just pointed out on the daily, gets us closer to 379.25 as a downside target, which makes complete sense from a measured move perspective. We should honestly look for a little bit deeper than that if we're going based on a purely measured move perspective from the technical viewpoint. So knowing that, not all that great of a look here on the hourly time frame chart. Let's have a look at market internals. This is a mashup of the four. So top left is our breadth. Top right is your advanced decline line. Ticks in the bottom left. This is the ES, or the SPY, actually on a 15 in the bottom right-hand corner. What I want to point out is just, again, the slowdown in what was going on with the internals. So flat on Tuesday, that was a real big warning on the impromptu update. The selling momentum was absolutely real on the Wednesday morning session, and today it lightened up a little bit, but definitely still some sell-side pressure out there in the market. Same thing with the advanced decline line, big negative trend. Remember, it's not really where you open unless you just go sideways throughout the day. It's the trend of the day in the advanced decliner, which was clearly down in this instance. What's interesting here, though, is that we actually trended higher on today's session in the advanced decliner as more stocks across the NYSE as a whole started to recapture the prior day's closing print and actually spend more time above. That's what this trend higher would be indicative of. So once again, the selling pressure abating a little bit, but where we're at on the SPY daily time frame chart, right around that critical weekly level, it's just too hard to make a determination right now. We're kind of in that neutral box, and things will improve or deteriorate as we cross the levels that we just discussed moments ago. In terms of the tick, I found this really interesting. We actually had a positive build into the close here, which is sort of counter to what you might have thought on the momentum. And even with the sell side momentum from the Wednesday session, notice that your cumulative build in the tick is actually flat. Now, I do think that TradingView gets the data slightly different from Thinkorswim, so I am excited to go back home and actually double check that and compare and contrast. I'll update you on the Sunday weekly watch list video as always, but for now, the main takeaway from the internals is that yes, the selling pressure was real on Wednesday, but things are already starting to slow down. The sellers may be out of gas. That might be all they had. If we can get back over 393.50, we know that that's a really constructive look for the market in the upward direction, finding a daily higher low and possibly re-interacting with the trend line. So the point of today's video, don't get as bearish as it may seem out there until we actually break the levels and you have a clean entry in the downward direction. This is the volume profile. Instead of looking at our market profile on Tradeovate, here it is, volume profile on TradingView. Too many trading app type things. Anyways, what we see here is value area actually being established lower in the session on Wednesday, which is indicative once again of a lack of acceptance up towards the highs. This is a concept that we talked about on Tuesday after the close, and the point of control certainly rotates lower with price as well, confirming the bearish nature of that day's session. If we look at today's session though, notice that it's not shifted lower in the overall range. It's actually smack in the middle, as is the point of control. So are things starting to slow down in terms of bearish momentum? It certainly seems that way. Once again, the closure and rejection off of the gap, though, has me a little bit nervous about being, bullish. So as of right now, I think it's quite clear the message of today's video is more neutrality and not being so quick to jump on the bear bandwagon, but also dialing back the expectations of the daily pullback on the spiders. So here are the 4 risk-on sectors. Top left here is your XLK. Here's your XLV Healthcare. Here's your XL, what did we put there? We put XLF, Financials, and here is the XLY, Consumer Discretionary, and underneath each is the ratio line that we would typically refer to in the ratio grid. The main point of this video, or excuse me, the segment of the video, is to point out that the risk-on sectors, they're starting to break down a little bit, but nothing's cause for concern just yet with new lower lows. There's still an opportunity for the XLK to find a higher low and actually pop back above the key level from right here. Well, we know that the XLV, the healthcare sector, is actually D for defensive, so not overly concerned with the break of this balance, but we don't really want to see it accelerate. The fact that we had a green day here in healthcare today was a pretty solid look in terms of keeping the market neutral and preventing a massive waterfall type sell-off. In terms of the XLF for financials, the opportunity is there, ripe, actually, to find that higher low off of 34.50. I know you probably can't see that level, but that's 34.50. That's exactly where we want to see the higher low. And we put in a little indecisive doji on today's session, so certainly an opportunity for that, which keeps the market actually slightly more bullish than bearish. Same thing happening here with your XLY. Definitely a pullback, but it's sitting right at the prime opportune level for a higher low pullback. Want to see that hold. That one's going to be around 135 flat. Okay. In terms of the ratio lines underneath, XLK continues to improve. It's not great because, of course, it's still underneath these highs from in here. XLV, overall uptrend still. XLF, still in an overall uptrend. Clear opportunity for a higher low in the ratio grid. And the XLY curling down a little bit on today's session here, but nothing to the degree where this doesn't have the opportunity to find some sort of higher low. Remember, we want this to turn into more than a counter trend move, and as of right now, it still unfortunately is just a counter trend move. Next slide is going to be the 4 risk off sectors. Top left, consumer staples XLP. Top right is going to be your XLE for energy, utilities XLU, and XLRE in the bottom right hand corner here. Big breakdowns across all of the risk off sectors. So the fact that these are not outperforming as the market is selling off, other than what we see here in the energy sector, to me, it's actually confirmation that things aren't, again, horrible. It's not like we're seeing a flight to safety. It was pretty broad-based selling on the Wednesday session. We'll talk about the fundamentals in just a second here. But, you know, to me, again, the fact that there is no flight to safety trade, the TLT is not outperforming right now, it just all comes together to say, hey, tap the brakes on the bearish narrative. I know it was obviously a really big sell type day, but we're not seeing the structural underpinnings of the market really deteriorate in a significant manner where all of a sudden we're net short instead of net long and considering, taking on new positions in the downward direction. It's just not there yet from a risk on, risk off perspective. Next up, we've got the VIX. What's going on with the VIX? A little bit of a tick higher here. Of course, should be expected when we see some sell side activity in the market, but notice that we're just right back at 2050, which, I mean, to be quite frank with you, is still really, really low from the quote unquote norm of 2022. So even with the sell-off, it's not like we saw some sort of capitulation type move into 35. Does it mean that we can continue to trend in the upward direction? Absolutely. That would probably coincide more with the scenario where we actually find a lower high, head and shoulders pattern on the hourly time frame SPY chart, and then possibly, of course, this gets an uptick here in your VIX. So I just wanted to point out that things aren't terrible across the board. That's the point of bringing the sectors into the video. That's the point of bringing the VIX into the video here. It's not like we're seeing some massive panic type move yet. It was really just the fact, here we go, this is the last slide I've got prepared for you from the mobile command station. It's that retail sales were so bad. Like the miss was terrible amid the month where you're expecting the largest gain, right? We're coming into the holiday season. We just got the December numbers. You should be expecting some pretty serious spending out there, and it just wasn't the case, right? And obviously that has big implications for what could be around the corner when it comes to earnings, right? And the way that earnings are going to be reported. Q4, as of right now, just checked in on the tracker. We're currently at a 61% beat rate, which is underneath the average of about 66%. So that's going to continue to stack up as a bearish data point, being more of a signal for the threat of a 2023 recession. These are just some headlines we snapped, right? Weak U.S. retail sales heighten the recession concerns. The economy is losing momentum as sales post the biggest drop in 12 months. Here's an interesting one, right? Because this has direct impact on Q1 earnings, possibly, of 2023. Nordstrom shares sink after it posts the weak holiday sales and slashes guidance going forward. It's really about the forward guidance there. And if the consumer's weak, right, then it just doesn't, it's not going to bode well for a really positive and robust earnings season in the first half of 2022. So why did we highlight this section right here? This is the retail spending report. It's because it was actually the only thing that was up, right? Net, we know that retail spending was way down, but this box represents things that were up, and it was building material and garden, as well as food and beverages. Now, let's just take a step back. Are those inflationary or deflationary? And I don't know about you, but those are definitely inflationary type metrics, seeing that those things are higher. So the fact that spending continues to outperform in those categories, also poses an issue for the Fed to continue to raise rates and continue the hiking campaign, right? Nothing about this report was really positive. Now, at the end of the day, let's be very, very clear here that it all boils back down to the price action of the S&P. If we take out key levels, if we take this out, we will look to go short. If we find a lower high, we will look to go short. If we get back above 393.50, we'll look to possibly think long over the resistance trend line, over the equal high from in here, right? Just because the fundamentals are really, really bearish right now, price is still king. So I know we wrap up, we end on the fundamental take here, but I don't want you to be overly bearish just yet because of this. This takes it's a much longer time horizon for the fundamentals to actually play out in the market, of course, right? So that's going to do it for the update on today's session. I wish you all a great trading Friday. I'm going to enjoy the Seattle gray and hopefully go have some good coffee, some good food. And I wish you all a green trading week.